Welcome back. We are back with Colin Cieszynski. He's our first guest of this hour. Colin is portfolio manager and chief market strategist at SIA Wealth Management. Colin, it's always great to have you aboard with us. Thanks a lot for making some time. Colin, let's begin with the tariff situation. It's front and center again. What is your view after months of watching markets digest new tariff information and announcements from the White House? What is your view on how markets are absorbing this information right now? U.S. markets are down today, not catastrophically down, but they're down about half a percentage point apiece or so on the latest announcement from the White House. The larger context, of course, is that these markets have surged to record highs very recently.
Absolutely. And it's something important for us to remember is that this whole rally started 3 months ago when President Trump said, OK, we're going to delay tariffs for 3 months. And since then, the markets kind of took all this as, oh, great, he's delayed it. He'll delay it again. He'll do whatever it takes to get a deal. And everything will be fine and happy again. And markets are taken off and literally gone to, as you said, gone to record highs as of Friday. And now we're seeing that the enthusiasm might have been a little bit overdone because the reality is deals aren't done. Deals aren't done until they're signed. Even ones that they've kind of announced, like the U.S. and the UK and Vietnam and even China, they've made progress, but they still haven't actually signed off on everything. And we've seen that even when you have an agreement, it's until the ink is drying on the paper, the deals aren't necessarily fully signed. So it's just we are getting a reminder that there's still risk out there. That although things look promising, it's not 100%, and that's why we're seeing markets starting to come back off today. And actually, where we're really seeing it is in the copper price, which is down 2.2%, because markets hate tariffs. Markets see tariffs as throwing sand in the gears of the global economy, and one of the places we're seeing that really play out is copper today.
How much risk is out there, Colin, for investors? The tariff threat has never gone away. It's been tossed out there. It's been dialed back. It's been tossed out there. It's been dialed back. It has not vanished to zero. And I don't think anybody predicts that we are headed to a global free trade environment of zero tariffs anytime soon. How much risk is out there to the global economy and, by extension, to stocks which are at elevated valuations?
Well, it's interesting because back in the winter, everybody thought there was a lot of risk. And then through the spring, that kind of started to go away. And the global economy remained relatively resilient, which is one of the other reasons why we saw stocks rally the way that they did. But there's still significant risks out there. And it's important for us to remember that this is happening as we're starting to move into the riskier and more volatile time of the year for the stock market as well. So it's not necessarily we may see a sharp impact, we may see stocks do well. It depends on what happens with earnings season. But the one thing it isn't is it's not time to be complacent because markets could still have some significant moves this year in either direction.
What's your view of the Canadian stock market, which of course is at record highs as well, at the same time when the Canadian economy is slowing down?
The Canadian market has held up quite well. Our largest stocks are multinationals, so even then they do have exposure to the United States. I think of things like the banks and the Shopifys of the world do have some exposure in the U.S. as well. And sometimes that can be a good thing. If the U.S. economy is strong, that can still be good for them. So we're seeing good strength in the Canadian market. It's important for us to remember that this wave of tariffs that is expiring. Canada is separate from that. The Canadian negotiations are completely separate because we have the U.S. Mexico-Canada trade agreement. We're not caught up in this other business that the other countries are getting caught up in. So Canada's held up relatively well, but at the same time, we are a resource producer, we are an exporting country, and if we did see a slowdown in the global economy, that could still impact us.
Canadian jobs will be reported on Friday, the labor force survey from Statistics Canada. What do you expect the tone of that report to be? Most recently, we have seen job losses in some trade and tariff-exposed areas of the Canadian economy.
And that could still be the case again, Paul. It depends on how much of that has worked its way through, or if it's still working its way through. I suspect the latter, since we're still in negotiations and there's still uncertainty there. The U.S. had a very strong employment report last week on the non-farm payrolls, but Canada, as I said, we're still on the wrong. Well, we're still being targeted for tariffs. and for adjustment in the terms of trade. So there's still a higher level of uncertainty in Canada right now that could impact the job market.
A lot of Canadian investors follow the price of crude oil lately. What do you think of the price of crude these days? It has rallied to we're looking at it now, about $68 per barrel. It's at 67.50 right now, and has been volatile. It's been in motion recently. What do you think of the current price of crude, and where do you see it going over the next 6 months?
Crude has held up relatively well, all things considered, and there's a couple of things. OPEC Plus announced a higher than expected supply increase for August, and one would think that would have knocked the price down, but it didn't. And this resumption of tariff concerns could have knocked the price down, but it didn't. And so, but what's important to remember with oil is that it's back in the mid 60s. It already tumbled after the ceasefire between Israel and Iran. So based on that, it's probably in a reasonable range given the level of tariff concerns already. So so far it's holding. If things get resolved and the global economy were to improve, then it may improve as well. On the other hand, if things go off the rails, then that could put pressure on oil. So it's another one of those markets that right now it seems to be in a reasonable spot, but where it goes from here is a little bit more cloudy because we don't know. We're kind of heading back into that where the markets go from tweet to tweet rather than looking at what's happening on the underlying side.
I had an interesting conversation this morning with a portfolio manager who, among many other things, said that the ongoing weakness in the U.S. dollar is a significant tailwind, a positive for big mega cap U.S. tech companies. But I'm interested in your view on big, large cap and mega cap companies at large, particularly those who sell their goods and services largely in non-U.S. markets. She said that applied to the likes of Microsoft, Google, and so on. What's your view of a weakening U.S. dollar? We're looking at it on our screen right now, and profitability and perhaps share prices at big mega cap U.S. companies.
Well, that's one of the things that is probably, I agree that it has been driving stocks higher for a couple of reasons. A falling U.S. dollar is good for their multinationals. It's good for their exporters. It makes their prices cheaper in other currencies. And also for the multinationals that have big overseas operations, when they convert those earnings back to U.S. dollars, they come back into a higher number of U.S. dollars. So that's good. And that's one of the things that may actually help in the upcoming earnings season is the fact that we've seen a substantial decline in the U.S. dollar. It's been the weakest 6 months of the year in decades. So it's been quite a downturn for the dollar.